Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, December 20th, 2023. It's 10:18 a.m. Eastern Times. I'm starting the video. I'm going to go over just a handful of charts in here. I came across this one yesterday. Find it very, very compelling. I'm assuming it's accurate. Somebody forwarded this to me. It was on the source says Bank of America Securities, so I'll assume it's accurate. And I wanted to show you how I analyze it. I'm going to show you a few more, keep it relatively brief, give you my thoughts. And that is number one, I got a post out to you late yesterday and another one on treasuries. That was on QQQ and NQ. Another one on treasuries today. I always say the charts are dynamic and so is my analysis and often my trading plan. So and this is just me, I'm suspending stops on the QQQ and Treasury ZB/TLT shorts. Those are ZB or Treasury bond futures. TLT or it's the ETF. And I'll get to those reasons again in here. But again, that's just me. Now, I'm an active trader. Even on the QQQ, there's kind of really two trades. There was just the active short-term pullback trade setup posted yesterday or the day before. And then there's a swing trade that's kind of evolved. And I'll get to that in a second. I'm looking on my primary trading account, NQ. As I speak, I'm down 3.5%. Now that's because I've been in and out, book profits along the way, jumped in, and so it's not necessarily where you might be if you're short QQQ. But let me start with this chart. Pretty dang compelling, and this is, as you can see here, the largest weekly corporate buybacks in our data history since 2009. And I think it's safe to say with inflation, over time, especially in recent years, I think it's very safe to say that if you proceed 2009, you're not going to see bigger buybacks. The stock market's much bigger. The dollar's worth a lot less, and et cetera, et cetera. But check it out. I mean, just a huge spike up again. And so what I did here is how I like to analyze. You can see other spikes, along the way, in recent years, especially with the zero interest rate policy the Fed's had in effect since this point. That was, remember, coming off the financial crisis, which ended in S&P bottomed in March of '09. And the Fed has kept the pedal to the metal with free and easy money or near free money. And so what that did, I've talked about it many times, it allowed companies that didn't even need to borrow, like Apple, who's always been cash flushed in recent decades, to go out and sell bonds at uber low rates and turn around and take the proceeds from those bonds, which are just borrowing cheap money, to buy their stock back. So you've seen more and more, and this is the whatever you want to call it, the one of the net effects of free or very cheap money. Now here's what I wanted to show you. So this is the way I tick. So looking at that chart, what I did is I took a screenshot of the NASDAQ 100. You could put the S&P. It's going to look this way. You just have a little more volatility, bigger moves in the NASDAQ 100. And so I sized it. This is the beginning right here. You probably can't see it in the video, but that's 2009. So there's a start right there. And this is where we're at right now. Here's the year breaks, 2010. So I tried to line them up as best I could. It may not be perfect. But the takeaway is you can see these spikes. So here's a big one back. The first really big one, you could see that, buybacks as money was getting cheaper and cheaper, were gradually, the trend was higher and higher. And then there was a big surge, and looks to be about probably around the beginning of the fourth quarter of 2013, just eyeballing it. And again, now the takeaway is, I keep in mind here, I put this dotted line, the vertical line, to line it up on the peak. So what you're seeing there is that's when the buybacks were kicking in, and that's when they peaked. And so you can see what that did to the market, right? Right here, you can see it really ramping up, starting about the middle of 2017, peaking right there towards the end of 2018, and that's that. And then when we peaked, there was a little drop. We had a drop there, another little surge, and then a pretty noticeable drop off that came right there. Then they started firing off their buy programs again, lifted the market up. some really big, hills, if you will, some big surges right there and these were all, if you look at this one in 2019, again, you can see the year break right here. You can see just a lot of buying kicking in that really started picking up right after the year started and was persistent up until this point right here. And then you see it fall off a cliff even before COVID hit. This is late 2019. This is, I'm assuming they put the year break right underneath, and you can see it falling off a cliff, the buybacks, and the market fell off a cliff too. So that was COVID. So maybe these lines, be shifted again here or there, but you get the gist of it. And there's another the surge. You can see right here, it started a surge in corporate buybacks, peaking right there at the dotted line, which aligns with that big run up, pull back there. And then it kind of plateaued, and then a couple big surges in 2021, 2022. So you had a lot of buybacks here, you can see, in 2021. I'm sorry, we weren't to 2022 yet. And so you can see I just kind of put the lines again on those peaks, and these are the buy programs. And then you can see right here before 2021 ended, again, I've tried to line this up best. Either way, you can see the buybacks just fell off a cliff there, and obviously the market was falling off. So I mean, we all know this isn't rocket science, it's simple mathematics. A buyback, what it does, if you are unfamiliar, your company buys its shares back off the open market, and so you have less shares out there, so every dollar the company earns is now divided among fewer shares. So it's it's a sleight of hand. It's a way to make a company's stock price look good despite what the fundamentals of the company are at that time. So you can, in other words, if you buy back enough of your stock, you can offset declining profits and fundamentals. And either way, we just know it's simple. Let's keep it even more simple than that. It's supply and demand. If there's more buyers of a stock at any one point in time, it's going to go up, and more sellers, it'll go down. So you can see, and we've had since 2022 started, that last bear, you had a few spurts of buying, but this one again just rocketed, and that mirrors, and this is 2023, so this is right here at the end of the year, and this is current. And so a lot of that accounts for stock buybacks, again, largest in history. It will be interesting. I'm going to, when the new year rolls out, I'm going to kind of put together at least one, maybe a couple posts and or videos, kind of just forecasting some things that I think will happen in 2024 for the year. I did a similar thing in the beginning of 2023 and in 2022, and I'll do it again. And one of those it'll be very interesting to see what kind of, how in the longer run these companies are going to look. They're buying back. When you look at every type of valuation metric, whether it's a regular P ratio, Shiller P ratio, all the different valuations of a company, we know we're at historic highs. The market, especially those market leading FANGs, are very overvalued. And so you have companies, one of my predictions now, it's not a hard prediction, it's just I wouldn't be surprised to see shareholder lawsuits within the next year or two against a lot of companies like Apple for deploying capital, buying. In other words, it's a waste of money. It'd be like you right now. Again, hindsight will tell, or time will tell. But going out, taking all your net worth and buying real estate at the top of what could be a market. We know that real estate, especially residential, has very little upside right now. Best prices may just hold up for a while. And so that's the same thing with Apple buying their stock back, especially if things really turn and you see, as I predict, Apple dropping 40-50+% over the next year or two. Then we'll see what happens. But I bet you there'll be a outcry of some of the shareholders. Why didn't you pay us that money? You had all that cash. Why didn't you pay it out in dividends? You made a poor investment decision to buy back the stock at nosebleed valuations. But either way, we'll see. I just want to point that out, that is something. And then the takeaway too is you can see these buybacks, they come in spurts. And then and it doesn't last long. They don't plateau like this, for a long time and then drop off. You have these little, it's like kind of like an EKG. And so I think it's safe to assume, especially with that such a big spike over the previous record, that this isn't going to last forever at that rate. And so, in other words, once that corporate those corporate buybacks dry up, which will probably be anywhere from right now until maybe the next month or so, there'll be a collapse of the bids. You'll probably see a lot of profit taking and not those guaranteed buyers or the buyers from the buyback program stepping in. Okay, so that's one chart. This one I shared the other day in the video. Just wanted to share it again in case you missed it, because I just want to show you a few charts that formulate my outlook for near term. When I say near term, my kind of bigger picture outlook. Near term meaning between now and and what we're going to see next year. And that's this one. As I just covered recently, the shaded areas are the recessions. I'm showing you all of them right here, and you can see, and pretty much without exception. And when I say without exception, if you want to look at this in the 50s, you can see a concurrent peak in the federal funds rate that coincided right at the beginning of the drop in the cycle and the recession. Again, the shaded line. In every other instance other than that one in the 50s, which was concurrent, there was a hiking cycle followed by a pause. Rates, holding up the federal funds rate again here in blue, and then comes the rate cuts, which also coincided with the recession. So there it is, hiking cycle. They paused for a little bit there, started cutting rates. Recession followed right after, almost immediately after. Again, relatively immediate. It's not the same day. When you're looking at a chart as we are here, spanning decades, immediately or relatively soon is measured in months, guys, not in minutes or days. So there it is. And again, study it, pull the chart. This isn't something I kind of conjured up. That you can get this chart anywhere. Even the Fed will provide this chart. I got it, I think, from Macro Trends, one of the other sites. So that's one of them. And so here it is, the market cheering, pricing in an almost near certainty we're going to start. The Fed has stopped. Here it is. We've stopped, paused, and then we're going to see this. Again, this is a hell of a track record. This is, batting about 1,000, meaning, zero misses there. So, and again, the market isn't always rational. People aren't rational. Most folks read the headlines, and Wall Street folks, those up there, the hedge funders and, hedge fund managers, investment bankers, they have to keep the machine going to make money to get their bonuses. So they're buying. And right now the trend's up. And the corporations are certainly buying. They're driving it up. And so, again, you have a lot of again, I can see the bullish headwinds, but that's been priced in. We've seen this coming for a long time. Long before the Fed even told you they were done, or most likely done, I'm sorry. The market was already pricing in they were going to be cutting rates next year. So anyway, very compelling chart. That's all I'm trying to show you. And of course, do with it what you want. It's not, micro analysis, it's macro analysis, longer term stuff. And this is the yield curve. There you can look at the 10-year treasury bond compared to the 1 year, or you can look at the 10-2. They're going to tell you the same story, and I've talked about this quite a bit. And again, this is another one with a virtually perfect track record. Without any whipsaws, and that says when the yield curve inverts, for those of you not familiar, it means when the typically longer term bonds are paying a higher rate than shorter term bonds because you're taking more risk, you're locking your money up for a longer period of time, and so they're going to have a higher interest rate than shorter term bonds. But when the yield curve inverts, short term bonds are actually that's the point where the 1 year bond, the yield on the 1 year treasury bond is more than the 10-year, or we'll look at the 10 and 2 down below in a minute. But you can see when they invert, there's the inversion, and then there's the uninversion when you cross back above. Again, that's what the term they use. And so, okay, there it is. There's your inversion. And look, this took years, several years actually, for the uninversion. And when the uninversion hit, right when it uninverted, the recession, of course, was declared. I hope you can see it in the video. If not, you need to, use a higher resolution monitor, or hopefully your phone will show it. Inversion. Right there, we came back at the line. Might have popped above it. Either way, you can call it an uninversion there, and then another spike down. Another solid uninversion, but either way, that was all recession from here to here. uh, inversion, inverted yield curve, reversion, or uninversion. I'm sorry. Inversion again, followed by another recession, another reversion right at there. So again, you can do it yourself, guys. You can see them all. Version, I'm sorry, reversion there. Then the recession followed a little later. So you can see it's not, look, study it, zoom in. It's not an exact timing indicator, but it's an indicator with a 100% track record. And again, we're not going back a couple quarters, a couple years. We're going back decades into, this goes back into the 60s here on this chart. So, and there's where we are. Oh, that was the last recession. It worked. We inverted right here, and then we uninverted right there. And then that was the recession that was it was in recent history, the shortest one, but it was a recession after COVID. Fed flooded the money, the market with money. And there's the inversion. And this may not be updated, but we're getting closer, pretty close to uninverting soon. And keep in mind, so Wall Street's whole stock market rally is based on the fact the Fed's going to cut, but yet there's not going to be a recession, so that's going to be bullish. Well, if that happens, if we stay on the same course and you see the short-term rates cut, they're going to go down more. We've already seen a pullback in long-term yields, but that's what the differential is. We'll get the bound to get it sooner or later. You never stay inverted for that long. Go back again and look at history, shows you. And this has been a long time coming already. So this is the 10 and 2 year. There's the inversion right here, which, what was that? It was either late 2021 or early 2022. I think early 2022. I'll have to check. And so that's it. We've been moving up, and we're going to revert. And when you do, that's when the recession comes, or shortly after. So again, I'm not the only one seeing this and knowing this. And again, these are pretty damn good, reliable indicators, and they're there. There's a lot behind it if you understand the forces of the costs of capital and money, and why an inverted yield curve is bearish, and has to do with everything, tightening, loosening, financial conditions, and then what the long end of the yield curve is doing versus the short end. So that's it, guys. This, coupled with the Fed funds rate, are pricing in almost a near certainty of a recession. And as I like to say, there's not one indicator that's 100%. You might have 100% track record, going back, but then maybe this will be the first time. Maybe this time it is different. Yeah, obviously, I don't believe that, but maybe it is. And so it'll be the first time in decades that it is different, meaning we don't get a recession once the yield curve uninverts. Okay, just a very quick look at the Qs, QQQ. Let me just make sure all this is up to date here. This is one of the boards on the 60-minute chart. Remember, we have what I'm referring to as a primary trend line coming off the October lows right there, and then this minor trend line, which is pending a sell signal. It's a 60-minute chart, so you're going to need to see a solid 60-minute close. I always say, don't on the opening candle right there, there's only 30 minutes, the first candle of the day. It's not even a full 60-minute stick. You get order imbalances. That's why I usually sit back, let the dust settle. We're still above there. You want to call that a sell signal, call what you want, call it a sell signal. If I look at NQ, I see a breakdown and we're back testing below. So I'll show you that here. Let me just show it to you. So there's NQ, and we have a breakdown clear, and this trend line is very well defined. So you can call it a sell signal if you want, call it what you want. For all the reasons I've already showed you, and I'm going to show you again. And again, my positioning, my energy trades are going up at multiples of what the NQ trade has been going down just in the last week or so here. Looking at where we're at now, this is what is that, December 13th. Remember, today's the 20th. The NQ is up as I speak, a whopping 1%. You can see it right there in the exactly 1% where it was back, back here a week ago or so. No, over a week ago, and right about a week ago. And so to me, that's fine. I talked about having a stop based on yesterday's high, which was at the close because the market went up to the close. But that's, to me, I'm kind of parking that right now. That's, again, just me. Doesn't have to be you. But let me show you one little micro level right here. I just noticed Well, we broke down a back test, so there it is. A breakdown back test offers an objective entry, still a divergent high, and there's some minor support there at 16,964 that should do the trick. And if we do that, by the way, guys, if we do it and we do it soon, it's normal to see, you break down. Sometimes you don't look back, and quite often you break down and then you back test and then you go down. But we've already put in these lows here today. We had several 60-minute candles right there, and so that would be a pretty decent sell signal taking out those lows, especially if it happened now with a rejection off the trend line, or happens soon, I should say. And again, that's how it looks, just the way I have it drawn here. You know what? I could tighten this up, and I'm going to do that right now. See, as I zoom in, sometimes these lines shift a little, and I pull it up here. Now what I've done is I've connected it in closer to these candles here, right there. Actually, you can have. That's how I like to draw a trend line. The more reactions, the better. I'll either include the candlestick shadows, the skinny part, or the bodies. And so that's it. Also, break down a back test. And this one, as I said this morning, got this one out to you before the open, just so you know my thoughts. This is TLT, and what we're looking at here are these overbought readings. Overbought meaning 70 or higher on the RSI. That is the magic number. It's not the magic number for every security. Some things, hit 70 and just keep going. 80 is a level, 85, depends on the security. But on TLT, especially in recent years, and when I have overbought readings in close proximity, I refer to that as a cluster. I always have. And you can see, so you had a cluster, 1, 2, 3 overbought readings, and that was effectively the top. As I said in that post, we either went down right away, there was an immediate down or almost immediate, or quite often it was still the top. We topped out there. We went sideways, if you want to look at it that way, where there was a down, but it was mostly sideways before the bigger trend came. And then you fell all the way to that low. So, in other words, if you shorted there, I always talk about being wrong or early. There's a difference on a trade. So let's just say you put a heavy short on, or a short on TLT here, and let's say you were targeting down here. So you shorted there based on your whatever sell signals you're using. You're looking for a, almost a 40% drop. So you gave yourself, let's say a 10% stop loss. That would be an excellent 4-to-1 RR. Your stop loss would be way up here. So in that case, you were early because you didn't take any profits, and you sat in a trade sideways for several months before it started to really turn profitable and play out. Okay. And so here it was almost immediate. You had a quick down. Maybe that was your price target. Or if you wanted, you were swinging for more, you went sideways. You never went above that high. You went sideways for, again, a few months and then down. But again, that's showing you, it doesn't guarantee it must happen again. It's just showing you a pattern, and there it is. That was really 2 boom, boom, close proximity tags, boom, boom, 2 close proximity tags. And the only missing ingredient right here is a bearish PPO crossover. And if you look at those, that's what I did. I studied it very closely. That tends to be when you start getting overbought on TLT, and again, you tend to get, at least a second tag there, like we had 1, 2, 1, 2, 3. And if you look closely down here at the PPO, and if I wanted to, I'll do it, put up the histogram. Histogram will show you. Let me just park the histogram. You can see what I'm doing. It's getting too many lines up here. These lines look like they were about to cross. They were turning down, and they bounced. The PPO line, that's the orange line. The white line's your signal line. So when the orange line, your PPO line, crosses down below, that's a bearish crossover. And what happens is, you can almost anticipate it, but nope, they bounced. The trend went up a little higher. They bounced once more when it looked like a bearish crossover was taking place, or maybe it was a whipsaw. I can't really see here. It looks like it bounced right on line. Then finally, that was the one that stuck, and PPO went down. It's a momentum indicator. There, it was turning down. You got the crossover right there, and then boom, you dropped. Here, we were about to cross. We bounced. Okay, pause it there for a second to take a phone call, but that's it. So, just like this time around, you have this what looks like an imminent crossover, you bounce. But again, if you look at the one of the things, there's a lot you can take from a PPO. You can look at crossovers, bullish and bearish. Obviously, bearish, I like to see high level. The higher, the better. Typically, that's when you get these major trend changes, when you get these high levels. Obviously, this one's as high as we've been right there. You can come across or even higher than that previous one. You can look at divergences. It's not all marked up here. This is my main board. You can see all the divergent highs and low, and those also call the turns. But that's it, guys. So just wanted to point those things out. So the takeaway is, going forward, some of the most reliable and longest dated indicators that don't give you very many signals, being the Fed funds rate, peaking, plateauing, or hiking cycle, going to a easing cycle, with zero misses, pretty much. At least all the recessions have come right after that. And the yield curve inversions, which again hasn't a reinversion, uninversion. I'm sorry, they call it uninverted, and that hasn't happened yet. But again, is imminent, and again, it's going to be guaranteed. So it's almost like heads I win, tails you lose to the stock market here, because if it gets what it wants, and that's the Fed cutting rates next year, especially the more aggressive cuts they're calling for, 3+ cuts, you're almost certainly going to invert the yield curve based on that, those short-term rates going down. So that's it. And again, that's kind of longer-term macro stuff. Short-term is this. We're going to keep going up. QQQ is going to keep going up. It's going to keep going up till one day it just stops going up. And then the $1,000,000 question is it going to are they going to keep buying the dip forever? Is it going to be mild, shallow pullbacks? If so, I've given you two minimal targets. This is that bearish rising wedge measured target, the purple line. I can't apply it yet and tell you where that line will end up, because it entails a break of this bigger wedge right here. But again, based on all this and this, this is a 60-minute chart. First time you go to the daily, you go to the weekly. You look at my chart, the analysis I just did on the semiconductors. These weekly divergences tell me that little seemingly minor, short-term trade pullback setup I showed you on the 60-minute chart, if it starts to play out and we hit those near-term pullback targets, it has the potential to be the beginning of a turn that will ultimately morph into a much bigger move down, just like this divergent high gave you that. This divergent high before COVID gave you that. This divergent high right here gave you that. These are all double-digit drops. That's the big Q4, fourth quarter 2018 drop. And here, those were both about 15% or so. And again, they're every one of the divergent highs going back on the weekly time frame here. So that's it. Bottom line, current momentum is bullish. There's a lot of corporate buybacks. Volumes are tapering. They're pretty much the only buyers right now, which I told you I'd stop. But remember back here when TLT peaked, this ramp up. That was the Fed was one of the biggest buyers, quantitative easing, and then very few individual buyers. And so I'm seeing the same thing right now in reverse. In other words, it's not absolute, obviously. There's probably a lot of retail, money chasing this rally. But by the chart I just showed you with the corporate buybacks, we know a huge amount, especially considering this is a very low volume time of the year, is from those corporate buybacks. So when that tapers off, that's going to be a huge bid or buyer, if you will, of stocks that goes away. And based on the, how I showed you before, those charts, those tend to peak. They come in spurts, those corporate buyback programs, even though it's not any one company, it's collectively, they all tend to kind of ebb and flow together. All right, I'm going to wrap it up here, get the video out to you guys. Again, I give you my thoughts, what I'm doing, but that's different from everyone else. I have, pretty well diversified and balanced portfolio, and nor do I have a very heavy position short the indexes right now, the stock indexes. So I'm going to give it a little room for now. All right, guys, this has been Randy Finney with Right Side of the Chart. Have a great day.